If you purchase that same $20,000 side-by-side in 24, you would take 60% of it right away. And then the rest of what's left of it, you will divide over the 5 years. Welcome back, everyone, to REI Tax University, where we talk all things tax planning for real estate investors. And we are currently deep in the weeds of our series on depreciation and all things depreciation and how investors can use that as a tax planning tool. And if you thought our talk so far on straight line depreciation was exciting, well, get ready to have your socks blown off because we're going to dive deep now into bonus depreciation. Now, we love all of you raging depreciation fans who want to watch along and hang on us word for word here, and that's great. But for anyone else who just wants to listen along and get some good content out of this, feel free to throw your phone in your pocket, stick your AirPods in, go for a walk, or do something you enjoy. We'll let you know if we put something up and you need to watch the screen. Well, bonus depreciation was first enacted in 2002, and it's meant to be an incentive to business owners and real estate investors to invest into large purchases and to help spur the economy. When it was first enacted, it was 30%. They quickly upped it to 50% in 2003, and then they upped it again to 50%. That's where it stayed until 2017 when the Tax Cut and Jobs Act came out, and that increased it to 100%. So from 2018 to 2022, it was 100%. We'll get more into what that means in a bit. And then from 23 to 2026, it is set to go down over time. So as of today, in 23, it was 80%, in 24, it was 60%, in 25, it was 40, it'll go to 20, and by 2027, it would be gone. Again, these numbers are just as of today. There could be something that Congress does to change this. They might reinstill 100% bonus depreciation. They might put it back to 50%. We don't know, but as of today, these are the numbers and where it's at. So what do all these percentages mean, and how does bonus depreciation work? Well, bonus depreciation allows you to take any of your fixed assets that you had to put on your balance sheet, other than building structures or building improvements. So other than those things that are 27 and a half years or 39 years. So let's think in terms of those assets that are 5 years, 7 years, 15 years. So think about things like your flooring and your cabinets and your equipment and your vehicles and those types of items. Think about your land improvements, so your driveways and your fences and things like that that you may have to do. Well, what bonus depreciation allows is you can essentially take a fixed asset that you had to depreciate normally over that life and take a big portion of it in year one. So when it was 100%, you could have taken 100% of it in year one. When it's now 60%, you can take 60% in year one. So taking a quick example of an asset that was purchased in 2022, a year in which bonus depreciation was at 100%. Let's assume you went and you bought a side-by-side for $20,000 to use in your investment properties. Normally, if you bought that side-by-side on January 1st, 2022, you could deduct $4,000 as your depreciation that year, right? You have a $20,000 fixed asset and it's divided over 5 years, $4,000 a year for 5 years. Now, if you're a taxpayer that has an average tax rate of 25%, you get that $4,000 deduction, and that's $1,000 in real tax savings, real money in your pocket. Some pretty good money for going and buying that side by side. However, if you decided to implement bonus depreciation and elect into bonus depreciation, instead of only deducting $4,000 in year one, you could have deducted the entire $20,000 in year one. If you did that and you were at a 25% average tax rate, you now save $5,000 in tax savings in real money in your pocket. So instead of having $1,000 today, you have $5,000 today. So what are some of the considerations of bonus depreciation and how does it all work in the real world? Well, first and foremost, bonus depreciation is optional. You can elect if you want to take bonus depreciation or if you want to just stick with your normal straight line depreciation. And there are times when straight line could be more beneficial to you. If you have a future year when you're going to have higher taxable income or a higher tax rate, and that's significant, it may be worth it to you to save some of those deductions for a future year. But for the most part, people are thinking about the time value of money. If everything's equal and put in a bubble, if you give me $5,000 today versus $1,000 a year for the next 5 years, I'll take the $5,000 today. I can reinvest that. I can pay something down. I can do what I want to with that $5,000. It's more valuable to me today than by taking $1,000 each year over 5 years. Now you have to consider that bonus depreciation can have consequences on your fixed asset basis, right? When we talked about basis before, we talked about how there's accumulated depreciation, and what basis is it's the purchase price and what it took to get that asset in service less that accumulated depreciation. Well, in this example of the side-by-side that's $20,000, you bought something for $20,000 and then you took depreciation of $20,000. So your basis in that asset is $0. Meaning if you're planning to go sell that next year or in a future year, you're going to potentially have some tax consequences. And those are things you need to be aware of and plan for. And we'll get a little bit more into depreciation recapture and what that looks like in a future video. So where's bonus depreciation gone over the last few years and where's it going? Well, we touched on this a little bit when we talked about the TCJA Act and what's happening over the next few years and the sunsetting of bonus depreciation on there. So if you purchased something in 2023, you would have taken 80% of it that first year. But we're in the year 24. Let's assume you you took it in 24 when we're in a 60% depreciation year. If you purchase that same $20,000 side by side in 24, you would take 60% of it right away. And then the rest of what's left of it, you will divide over the 5 years, right? So you would have $12,000 in year one, and then you would take the rest of the $8,000 and divide that over 5 years. So $1,600 a year from year one to year five. So your year one depreciation deduction would be $13,600. Year two would be $1,600. Year three would be $1,600 until year five, when you've used it all up and you now have no depreciation left on that asset and your basis is down to zero. Again, remember that building structures and building improvements on those 27.5-year rentals and those 39-year rentals, that does not qualify for bonus depreciation. Those, your only option on them is going to be straight line depreciation over the 39 years or the 27.5 years. And in a future video, we're going to get into cost segregations and how you may be able to split some of that out into these other life properties so that you can use bonus depreciation on it. Some other items that come up here is you need to be aware of if you're meeting real estate professional status or if it's a short-term rental and you materially participate in it. Now, we've talked about that in some other videos and we'll get deeper into that in some future ones as well. But for right now, just consider that if in a given year you meet one of those statuses, that's the year when it may make sense to really opt all into this bonus depreciation strategy. And if in a year you don't meet one of those, it may not make as much sense to go in and get bonus depreciation. It might make sense to just straight line it for a while and take bonus in the future. Now, we could do a whole series on bonus depreciation. This is a pretty complex topic and there's a lot of different avenues that you can go with it. Maybe in the future, we'll do a small sub-series on just bonus depreciation. But from this video, we want you to get enough information that you understand what bonus depreciation is and start to think about how you may be able to implement it effectively to help you with your tax reduction in your real estate investments. If you found the content in this video useful, we encourage you to please like and subscribe and join us over at reitaxu.com, where we talk all things tax planning for real estate investors. And be sure to keep following along with our series here on depreciation and catch part 4 next, where we're going to talk about cost segregations and how you can potentially break out pieces and components of the 39-year and 27.5-year buildings and take bonus depreciation on those by utilizing a cost segregation study.